Live, our series of online explanatory conversations with people who are domain experts on subjects that are in the news. I am Monojit Majumdar, editor for explanatory journalism at the Indian Express. Ever since I became President of the United States for the second time, Donald Trump has been taking actions and making statements that are triggering concern or alarm in capitals around the world. For India, Trump's plans on tariffs and immigration are of greatest concern. Our focus this evening is on the former, the trade tariffs imposed or announced by the US President and their impact on India's economy and stock markets. There are several questions here, some of which have been making policymakers and investors nervous. The stock markets have been volatile, and there is uncertainty on when stability might return. The expert we have today is uniquely qualified to answer some of these questions and hopefully offer some reassurance too, even though we will not insist on that. Anish Tawakley is Co-CIO Equity at ICICI Prudential AMC and a keen observer and analyst of the Indian and the global economy with more than 2 decades of expertise in capital markets and strategic consulting. With AUM of 1 lakh crore across a wide range of strategies, Anish's top-down view on the economy and markets has been a guiding force for the fund management team during the investment process. Anish is also a crucial sounding board for the Indian Express, an expert to whom we often turn while trying to understand market movements and related issues. Anish, welcome to the Indian Express. Thank you for your time. We are honored and very grateful to you.
Thanks, Monojit. Pleasure being here.
Speaking to Anish will be my colleague Sandeep Singh, editor of the Mumbai edition of the Indian Express. Sandeep is a bit of an expert in the economy and markets himself, having covered the beat for a very long time. So I'm sure this will be a fascinating conversation. Today's event is brought to you by our partner, Avito. My thanks to our partner. At the end, Anish will take a few questions from the audience as well. Thank you all for joining and welcome once again. Sandeep.
Yeah. While Monojit has introduced Anish, I would like to say for me, he's a go-to person when we have to understand the complexities of policy decisions and impact. And so when we thought of, when we're looking to unravel the complexities of tariff and its impact on the Indian economy and the markets, we thought who better than Anish to connect the dots on the same. So to start, Anish, I'd like to first ask, rather than going into how it impacts others, but how President Trump's tariff threats will, do you think it is going to benefit America or the Americans in any particular manner? While he's going on and on with that, he's talking about that. Is it going to benefit America and the Americans in particular? Yeah.
See, the good thing here is that tariffs as an instrument are not a new instrument. They've been around for 250 plus years. The first time I think they were studied were 250 years ago when the corn laws were discussed in the UK, right? So there's a lot of theory which exists for understanding this. So we can step away sort of from the personalities and look at what the theory says. So firstly, right, the impact on jobs, which is often discussed. So let's understand where the US economy is in the cycle today. It is actually a very strong economy. Output today is not constrained by jobs. It's constrained by the number of workers. Right? US unemployment is at near all-time lows, multi-decadal lows. So in this environment, it's not that people are looking for work. It's that employers are looking for workers. Right? So if you impose tariffs in this kind of environment, there's not going to be an increase in output, right? So that's the first thing. Now, if you say, look, that's point one. The second point you need to understand is that if you say, look, we want to import less, and you cannot increase domestic output more because output is constrained by workers, then you have to consume less, right? Because you're producing the same amount, you're importing less, so you have to consume less. So your standard of living has to drop. It's not going to improve. That's point two. Point three, and this is a more subtle one, we have to understand that capital flows, the capital account, and the trade flows or the current account are two sides of the same coin, right? Ultimately, capital inflows either lead in current account outflows or you have to increase reserves. The US doesn't maintain reserves because it is itself the reserve currency. I mean, they maintain some reserves of gold, but they don't change that very much. So if you want to attract investment, which is what you're saying, look, our objective is to attract investment, which means we want an inflow on the capital account. You are by definition saying that we're okay running a current account deficit, right? So it's not mathematically possible to attract investment and not run a current account deficit. That is a simple reality one has to understand. And if you want to reserve a reserve currency, which again is an objective of the US, which means you want to attract foreign capital in the form of reserves of the US, you are also then saying we will run a current account deficit. So I think, ultimately the laws of economics cannot be outlawed. You cannot get around these constraints. So my point is, let's see how the policy evolves before jumping to conclusions and reacting on what might happen, right? Let's see, because there are real boundary conditions which are set by the laws of economics around what tariffs can and cannot achieve.
So in that case, is it largely political posturing, and will he have to slowly claw back to what he's now saying if it doesn't add up, basically, as you're pointing out?
So my point is, look, I'm an economist. Yeah. I'm not a geopolitical analyst. I would not like to comment on. I can say, look, if X happens in policy terms, Y is an inevitable outcome. I cannot say what's going on in somebody's mind, right, or what other objectives may be driving some of the decision making.
Okay. Now coming to the impact on India, I mean, Trump has been perceived to be friendly towards India. I mean, that is what the perception was, even when there's a lot of euphoria that okay, Trump is going to win and it will be good for India. Now, but as he announced plans for reciprocal tariffs and he made it quite vocally, that could see duty on Indian items go up. And how badly can this hurt India and its economy, considering the items and product mix that are exported by the two countries are very different?
So see, there will be industry-specific impacts, and it's difficult to gauge all of them. But if I were to look at some of the major items that we export, right? Say pharmaceuticals. I mean, let's understand the dynamics of that industry, right? More than 1/3 of the volume of drugs consumed in the US are made in India, right? There are very few alternative suppliers for those drugs at that scale, right? And a tariff is just like, in many ways, a tariff is like a sales tax, right? So when you levy a tariff, part of it depending on the specific supply demand situation. Part of it has to be borne by the consumers, part of it has to be borne by the producers, right? And when there are very few alternative suppliers, which means the supply curve is inelastic, right? Large part of it is borne by the consumers, right? Because there are no alternative suppliers. It's not as if the pharma industry is making supernormal profits or profits. I mean, they might be making some supernormal profit, but those are not that very large. So a lot of the burden will therefore be passed on to the consumers. And so on an industry, there might be some industries where there's an impact, but overall on the Indian economy, I would not expect it to be a major impact.
So why would you say that there is? So why this the whole confusion and then this whole talk about and the market reaction? I mean, if
See, I'll tell you, like, if you were to ask me about the Indian market, right, and if you say, look, what is the most important, a lot of the factors that will determine how the economy does overall will be domestic, right? Let's understand what role economic exports play in the overall economics stuff, right? Why do you really need exports to pay for your imports, right? At the end of the day, right? There's no inherent virtue in exports beyond the fact that they allow you to pay for your imports. Our current account deficit is fine. I mean, it's about 1.5% of GDP, which is fine. And I say it's fine because if you say, look, we want to attract foreign investment, as I said earlier, the capital account and current account are two sides of the same coin. So if you want to attract investment, you'll run a current account deficit. A current account deficit of 1.5% is part of our thing. Now, if you say, look, there will be some export restrictions, they come down a little bit, yeah, the exchange rate can flex to accommodate that. Some of these things will be very difficult to replace anyway. So overall, in the bigger scheme of things, I'm not saying there's no industry that will be affected at all, but on the bigger scheme of things in the economy, the adjustment can take place and it will the economy will absorb that impact. The bigger driver of Indian economy, right, is whether we get our domestic side right. And for me, the most important thing there, and I think I've written about it also in one of the columns that I wrote for your paper, is the whether our housing and urbanization story plays out, right? If we manage to continue to build houses, continue to expand cities, we'll be creating jobs. If you build houses, there is domestic demand for manufactured goods because nobody lives in an empty house. If you have more houses, you will have more demand for things like lighting, furniture, textiles, whatever have you, and that will drive the domestic economy. I think too much concern about what is the specific level of tariffs in every small little thing is at the economic level is unmerited.
One more question on tariffs, and then we'll link it to the markets. India and US have announced a trade deal, but Indian average tariffs are over 12% and compared to less than 2% in the US. Will the deal generally involves lowering tariffs by both the countries not help US exports more into India? And where does India in that case gain in the deal?
No, so look, ultimately we will adjust our exchange rate or see any country that the short answer is the exchange rate will adjust so that the current account deficit remains at the same level. Now, there may be some industries that see some additional imports, but that's fine. And the Indian consumer will benefit. See, one thing you have to remember about tariffs, it's not the impact on different parts of the economy is different, right? So for example, if you levy tariffs on steel, it's great for steel producers, but it harms steel consumers. So one should not just talk about the impact in aggregate, right? There are winners and losers within the country. It's not like just you have to look at US winners versus Indian winners. There are losers and winners within the country. So if a country imposes tariff on steel, the steel producers benefit, but all the downstream industries suffer, they lose competitiveness. So it's very, very, it's not useful to do a top-down analysis and say the whole country will suffer. It will not. I mean, some of us might benefit from getting US goods at cheaper prices, which were more competitive. And if some industries lose in that sense, it's not a problem. But ultimately, the exchange rate will adjust so that our overall net imports remain contained. Right? Think about it this way, right? India lowered tariffs. I mean, when we were growing up in the 90s, India had such high tariffs. We lowered them so much. Did it hurt the economy? No, right? Because did our current account deficit blow up to 10% of GDP? No, because the exchange rate adjusted to make sure that the current account deficit remained reasonable. Ultimately, I mean, let's understand, our net imports are also the recipient. When we are a net importer, we are also a net recipient of investment, right? So there's only so much investment that is going to come into the country. And if that is the case, there's only so much net imports that will come into the country, and the exchange rate will adjust to balance the two. I remember tariffs in India on many things were 50, 60, 70%, right? They've come down to 10%, 5%, nothing. But the economy is still fine. The current account deficit, if anything, is lower than what it was in those times.
Okay. Now, while you say that the impact on economy will not be as much, the markets have reacted significantly to it. Since Trump's victory in the US elections, and then after his inaugural speech, we saw further dent. I mean, do you think that while Trump was perceived to be friendly towards India, his announcements on reciprocal tariff on India came as a shock for those who were bullish on India and had parked funds into Indian markets? I mean, is that a reaction? Because we have seen around $14 billion went between November and February. Net outflow, foreign outflows, portfolio funds. And if we include October, it is almost double, because around 94,000 crore went out in October as well. So how do you see that? I mean, what does it reflect?
So there is current account, which reflects the realities of the economy, and there are capital flows that reflects mood swings of investors and perceived risks, perceived causes, which may not really be that relevant. See, what we have been saying for a while is that the small and mid cap segment of the market was expensive. We've been saying that for a long period of time, and that correction was due. Right now, if it's happened, that segment of the market was very overvalued. It's happened. We would argue there's still some room to go. So people will look at, what happened in the last 1 month, and ascribe that as a cause. That causal relationship may or may not exist. I think I wouldn't attribute it that way. It is not like, if you look at the kind of selling that has happened in the Indian market, some of those flows, right? It is not just FIIs, it is also MNC promoters who have chosen to exit, which they felt, we might as well encash some of the value we've created now, because the valuations in the Indian market are so conducive for doing that. So it's not just the Trump tariff threats, it was the valuation levels of the Indian market that were also relevant to these decisions of people taking money out. See, if the economy, sorry, can you hear me? Sandeep, you're muted.
Oh, sorry. Yeah. So I was asking, so how do you see rupee movement to be playing out in this developing trade conflict scenario?
Actually, let's first look at the dollar, right? If you look at the DXY, which is a composite measure of the value of the dollar, that has already started dropping. It peaked at around 109 and is now at 106 and something. So in some senses, it's not the rupee movement is unique, right? It's still under pressure. Now, when I look at the value of the rupee, right, and I say, is it fair, is it cheap, or is it expensive? The most important variable there is the current account. If the current account is fine, right, then I don't see an economic reason why we need to have the rupee depreciate. As I said, the current account reflects the realities of the economy, and the capital account, apart from the realities and views of the future, reflects mood swings in capital markets as well, international capital markets as well. So when I look at the current account, I'm not so worried about the rupee. If people continue to take their money out, it may be under pressure for some time, but beyond the point, we have the reserves also to deal with it. And frankly, if the economy starts growing again, the flows will come back in, right? As I said, flows are volatile. So one has to form a view on the economy, and then the rupee should follow from that. So my view is that, I do expect the economy to regain momentum. And if that happens, there is no fundamental reason why the rupee should continue to depreciate. In fact, I would expect over a year's time, the rupee to probably strengthen a bit from here.
But how long it may take for the markets to adjust to the new realities? I mean, is there a re-rating sorts happening on India among large investors?
No, so what I'm trying to say is, Sandeep, that it's not the reality of the external world only that the markets are reacting to, right? The reality is that the Indian economy did also slow in the past 6 months, right? It's not as if the Indian economy itself has not slowed, irrespective of what is happening on the tariffs. Now, then we say, okay, what's the nature of this slowdown, right? Does it reflect any fundamental macroeconomic instability in the economy? It does not, right? The current account deficit is fine, inflation is fine, corporate balance sheets are healthy, bank balance sheets are healthy. So there is no fundamental problem in the economy. Only thing the economy is suffering from is weak demand. Right? Now, weak demand is an easily solvable problem. I mean, fiscal and monetary policy can be used to address weak demand. I think to some extent we got a little bit of fiscal support in the budget, and I do hope that we continue to get more support from the monetary side. Between fiscal and monetary, anyway, monetary is preferable because monetary can be reversed once the economy recovers, right? So my view is, given that there is no macro instability issue in the Indian economy, given that it's only an issue of demand, and that the RBI is supportive of reviving demand, I do think the Indian economy will regain momentum. And if it does regain momentum, then capital flows will also come back. Right? Now, how long that will take? Difficult to say. It could be 1 quarter, it could be 2 quarters. But as long as the monetary policy side of it is supportive, there is no reason to believe that the economy will continue to languish. The only thing I would watch in addition to what I said was that, we do need the housing sector to do well, right? We do need housing activity for the economy to sustain a recovery. And what should not happen, right, is that house prices rise to levels which kills activity, right? Because people feel good where the house prices go up. But if it's killing economic activity and no further construction is happening, then that becomes a deterrent to economic growth. So the one variable that I would watch is that, like, house prices which have moved up a lot should ease off to the point that demand comes back, right? In the last 6 months, we've seen some fall off in the rate of absorption of housing. So new sales have declined a little bit. I would hope that there's enough competition in the market that developers, bring prices to more reasonable levels so that housing activity recovers. So again, my point is that factors that affect the Indian economy right now are mostly domestic. It's monetary policy and the housing market. If both those recover, the economy should do well, irrespective of what happens on the tariffs.
Yeah. So while tariff, I mean, as you are very clearly saying that it is not going to have a huge impact on the or impact on the economy. It's largely our domestic factors that have to,
yes,
on the consumption side, basically that needs
no consumption. So housing is investment. See, actually, there's a lot of, and this was a point which I think was even misunderstood when the budget came out. Right? People said it's a consumption budget. No, it's saying, look, they want households to spend, whether they spend on consumption or whether they say, look, I was going to buy a house 1 year later. Now I have more money. I can pay the deposit up front. Or I buy a slightly larger house because I can afford it. It could stimulate investment spending as well, right? So, and interest rate cuts normally, if they happen, also work on investment spending. And I do think like housing is a very important part of that.
So is the whole fear around this tariff? I mean, that daily we talk, daily we read and hear. I mean, when you are pointing it
out, I don't think it's the most important factor for the Indian economy at the moment, right? The more important factors are domestic. See, look, let's look at China, right? They grew 40 years at 10%, right? Without a blip, 40, maybe 35 years, 10% per annum. Tariffs were imposed, tariffs were removed. There was a global. Why? Because they got their domestic side of the economy right. They got urbanization and home building right. And then the economy sustains itself. So I think there is too much focus. As long as the current account is fine, oil prices don't go to $200, I think the economy is fairly resilient, right? I mean, think about it this way, right? The economy didn't slow down when oil went to 120. The impact of tariffs is not going to be worse than that, right? On net exports, it's not going to be worse than that. So I do think like there's too much. It's nice to talk about it. It creates headlines, but I don't think it affects the reality of the economy as starkly.
No, it has given some clarity on that front. So, do you think the budget exercise in that sense, the announcements that were made on the taxation front, do you think that will have a revival now that we are talking of domestic economy and tariffs are out?
No, of course. I mean, if the demand is soft and you give a tax relief, it helps the economy. And as I said, it can help both spur consumption and investment spending. One should not assume that it only spurs consumption spending. And equally importantly, monetary policy, to the extent that the RBI has eased both some of the regulatory constraints and provided liquidity and cut rates. I think monetary is really the support that would be ideal for the economy. As I said, the difference between monetary and fiscal is that both work, but monetary is easier to reverse once the revival takes place. If you go back to the previous cycle, right, 2008 to 2013-14, and you see what happened in the Indian economy. There was a global financial crisis. Economy recovered really fast from that, right? Because there was both a monetary and a fiscal stimulus. The problem came later because the fiscal stimulus was not withdrawn, because fiscal stimulus is always very difficult to withdraw. So even after the economy had recovered, government was spending. And that led to overheating of the economy. If it had been only monetary stimulus, it would have been reversed, right? So between fiscal and monetary, I always prefer a monetary stimulus.
It's a nice, easy handle to play with. Yeah. Right. Now, looking at some basket of goods that India imports from US and exports to US, which sectors you think will be directly impacted? Because within the larger economic framework impact also, there would be some sectors that may get impacted. So just to kind of get a sense on.
So that's a fair question. Look, as I said, right, pharmaceuticals, we are a big exporter. I mean, even if there were reciprocal tariffs, the US makes some very high priced drugs, which frankly, they make some what are called patented drugs, right? Which even if we import, there is it's good. It'll help the consumers. There is not much domestic manufacturing of that anyway. If you look at textiles, let's say there are reciprocal tariffs, right? The US is not producing much textiles anyway. So would we import shirts made in the US? Very unlikely. Even without tariffs, shirts made in the US would be very uncompetitive in India. So you tell me, who's going to sit down in the US in a factory and work, the hours that an Indian or a Chinese or a Vietnamese worker works to supply goods, shirts to India. So I don't think, that even in textiles, the reciprocal tariffs will matter all that much. Right? Actually, the reality is Indian economy and the US economy do very different things. US makes it, and actually, the other thing people don't realize is that it's not as if US manufacturing is weak, right? Between US and China, let me ask you this, right? Manufacturing GDP, manufacturing output or per capita in dollar terms, who has higher?
Should be US.
Yeah. US manufacturing output per capita is $8,000. Chinese is $3,000. Why? Because the US makes Boeing aircraft. When you sell one Boeing aircraft, that's equivalent to 40 million shirts. But you go into a supermarket and you see shirts. So you say, oh, there's so much stuff coming from China. The US is selling one Boeing for that. 40 million shirts. That's probably the entire male population of several European countries, including Germany or so. And then we say, oh, there's so much stuff coming from here. People forgetting that, when you buy one Boeing or whatever, which is made in the USA. Now, would we have a problem lowering tariffs on aircraft? No, it would be fine. Right? There's no domestic consequence to that.
We've also not seen Indian government talking too much on this tariff, while the debate discussion has been mostly in media and experts and all that. But what is the best way, for the Indian government to navigate this tariff challenge or whatever President Trump is talking about? What is the way forward for maybe the Indian?
I'm sure there are smart people in the government working on it. And I'm sure they'll navigate it. I really don't frankly, I think the Indian economy has handled tariff reductions earlier. It would be fine. Consumers would benefit in some sectors. Some sectors might see a little bit of pain. That's okay. Other sectors will come up to take that thing. I mean, I really can't see what we would suddenly start, what we would suddenly start importing in such large numbers from the US, which we are already not doing.
Yeah. Also, in terms of jobs, I mean, it's not that a lot of jobs will go out of India that are currently here. I mean, is there something that you can see?
No, see, most of the jobs that rely on the US economy are in the IT space, right? Firstly, I haven't heard much talk of taxing IT. And again, like if you were to tax IT, I mean, the margins of the companies are not like exorbitantly high. So even, one thing China did once when tariffs were imposed, they applied an export duty, right? They said rather than the US government collecting taxes, let us collect it ourselves. There is no alternative to that, to Chinese production. So if you want to restrict, we'll do it ourselves, right? So if for example, US said we are going to tax IT exports, I think we could also do the same thing. Put an export duty. They will be passed the cost. They will just raise prices to the extent of the increased costs, and the government will collect that. Indian government will collect the taxes. The reality is, with US unemployment so low, if you tax Indian IT, there aren't enough workers in the US to replace them, leaving aside even the cost. So again, I'm really telling you, the worries are overdone. There are other issues to deal with. It's not the most important defining factor for how the Indian economy does.
Will it impact the Europe more when he talks of 25% tariff? I mean, India is maybe because the cost of production and all is different for India, but will Europe have an impact? And also, given a globalized world that we are living in, and we know that everything is connected.
So I would again say, look at start with capital flows, right? And say, look, capital flow and then trade flows are the flip side of that, right? What would happen if you started taxing, like Germany in Europe, right? If you see, Germany supplies capital to the US, actually. This is one of the things that I always say, like we sitting here, right, think that the money that we are receiving is actually coming from the US. It's not. US is only the intermediary. The suppliers of capital the big suppliers of capital are the Middle Eastern countries, China, Japan, and Germany, right? They put money, buy US government bonds, that frees up US capital, and then the Americans invest in India, right? So US is only an intermediary in this capital flow process. So firstly, okay, yes, if you stopped importing stuff like cars from Germany, fine, you stop importing them. Do you have workers to produce more cars in the US? I doubt it. Otherwise, US unemployment would not have been so low. So yes, Germany will be hit, right? The German car producers will be hit, but so will US consumers be. And have the Americans signed up for having less to consume and for more effort? I'm not sure, right? Because ultimately what you're saying is if you want to reduce imports, you want to reduce your standard of living, which is effectively saying you'll do the same amount of work and have less to consume. Have people signed up for that? I think we can have our views on that.
Yeah. But then amidst all this, finally the question that comes up is when does this outflow of funds stabilize? I mean, because
this is a relevant question, right? Yeah. And my simple point is, firstly, you should not be investing in equity for a year, right? If you take a 3-year view, there will be. That's at least, and I say, if you're investing in equities, you should have at least a 3-year view. Otherwise, you should not invest. Now, over a period of 3 years, there will be 3 times that foreign investors will come in, and there will be 3 times that foreign investors will go out. It will not matter, right? When they go out, you can increase your investment. When they come in and they raise valuations, you can reduce your investment if you really want to do that, right? What will matter is earnings growth. See, think about it this way, right? Let's say what is the PE multiple of the market today? Somewhere around 20. Just let's use ballpark 20, right? 3 years later, earnings growth will be a far bigger driver, right? Earnings compounding. Even if the 20 becomes 19, if earnings growth has been healthy, your returns will be fine. If earnings growth has been weak, your returns will not be fine, even if the multiple goes from 20 to 21, because that 20 to 21 will add only 5% to your return over 3-year period, right? So in some ways, simple way to think about it is flows impact multiples over the short term. Over any reasonable period of time, the multiple is a very small driver of the returns you generate. The earnings growth is far bigger driver. And earnings growth, as I was explaining, for me at least, it's very clear it depends on the domestic economy.
Mm-hmm. So would you also say that maybe since there was a concern on higher valuations, this tariff thing came as an
trigger, catalyst, which kind of made people think and said, okay,
okay, we need some correction. Okay, this is there. So to book profits and for FPIs to maybe exit and
as I said, the economy also slowed, right? So that slowing of the economy had nothing to do with tariffs.
Yeah. And you said 1 to 2 quarters, but when do you think? I mean, based on what was projected in the budget and how the budget was presented, I mean, how far are we from consumption growth, investment-led growth? Because that is what is really that is bothering. Investments haven't happened, even though the corporate taxes were cut several years back. Bank balance sheets, corporate balance sheets, people say are maybe the healthiest ever. So
this is the other thing, that this notion that investment did not pick up continues to pervade, is a very pervasive notion which defies people looking at the data. Let's look at the capital, heavy investment sectors. Cement has been investing, steel has been investing, and in the home building has been happening, right? So these are 3 investment. The other one is power, right? Where power, the situation has changed now because renewables require less capex, and a lot of the capex capacity addition has been in renewables. The capital requirement has been worse. So the capital investment number looks smaller, but actually capacity creation has been pretty adequate. So if you look at private investment in the 2003 to 2008 period, it went up from 20% of GDP to 30% of GDP. Right? In the last, I shouldn't say in the last. We have data only till FY23. So that had moved up from 20 to 23. FY24 was a good year, so it would have probably moved up more. Right? It's only FY25 where we are seeing a slight sluggishness. So it's not as if investments are not happening. I mean, I like every single sector, the capex has been ramped up. So this notion, I don't know why it still persists that private sector capex has not picked up. House building is a very large part of private sector capex. And I do hope that regains momentum, which it has lost a little bit in the last 6 months.
Okay. So we are on the right track in that sense. Would you?
I don't see there is no fundamental.
And in that case, where does your concern lie? Which part? Where would you put your finger that if we sort this out, then maybe the slowdown in the growth that we have been talking on can be resurrected?
No, so I do think like monetary policy can ease. So that's clearly one. I do hope that monetary policy supports growth. Second, see what the other thing that went wrong in the previous cycle, right, was that house prices rose too much, developers went bankrupt, and house prices then remained stuck at a level where there was no demand. That's essentially what happened in 2010, right? In 2002, house building activity started because we introduced SARFAESI. SARFAESI was introduced in 2003. That gave lenders the confidence to lend because you could repossess the home. Before that, there were no home loans. So that created demand for housing, right? But the supply side was unreformed, right? So developers took the money, they didn't build the houses, they bought more land. And the stock market was valuing land, so developers could just list and get rich, right? You created wealth by listing in the stock market by buying land. So That is what led to the real estate cycle breaking in that period 2009-10 and then not recovering. This time around, the things that have been implemented, whether it's RERA, whether it's insolvency or bankruptcy code, should mean that now, in theory, this is what we are looking for, right? That look, if house prices go up too much, but because developers are under pressure because of RERA, because the stock market is not valuing land banks, stock market is actually this time looking at sales, pre-sales, whatever have you, deliveries, house prices will adjust downwards and economic activity will resume, right? If what I would worry about if we got another situation where for whatever reason, right, which I can't think of right now, but that doesn't mean it won't happen. For some reason that house prices remain stuck at a level where there is no demand and economic activity stalls. That would be a key risk. I wouldn't call it a risk because I'm not I mean, it is a risk, let's put it this way, right? It could happen. I can't rule it out. That's not my base case, but that is a risk.
Okay. I'll read out one question, an interesting question that is there from in the chat from Mr. Tarun Kohli. Do you feel this tariff approach by Trump will lead to bilateral agreement between USA, India eventually, which will address some of the concerns? India being big market for the US as well may not be penalized, especially when India is also a good check against China as far as USA is concerned. What is your viewpoint on this?
See, this India and China comparison, I think is very, very flawed. India and China play fundamentally different roles in the global economy. China is a supplier of capital. We like a lot of times people say, investment has, FI is not investing in China. Because China is the net supplier of capital. China is buying the US government bonds, which allows the FIs to have funds to invest elsewhere in the world, right? So there is no point even saying, look, China and India are replacements. We are a recipient of capital. China is a supplier of capital. We are not going to start supplying capital to the US. So there is no point even making that comparison. Whether a bilateral agreement happens or not, I mean, as I said, my approach is, look, let's understand what the economics of the case is. Economic laws will prevail. Bilateral agreement may happen. We'll evaluate it after it happens. There is no point making predictions when there is so much uncertainty. There is very, very high degree of uncertainty about what people will do. But there is enough economic theory for us to understand what the implications of their doing X, Y, or Z will have. And I'm focusing on understanding the implications of the various scenarios. I'm not interested in predicting the scenarios because I can't.
No, often this also this the whole theory about India will benefit from manufacturing. A lot of manufacturing will get set up in India. There was a stop in the last couple of years. PLI was pushed. Have we benefited as much? I mean, also some people think that tariffs on China will lead to manufacturing in India. I mean, is that does it stand anywhere?
I don't subscribe to that view, right? As I said, let's start with the external account. If we want to attract investment into the country, we will run a current account deficit. That's a mathematical reality, right? So first you decide, do you want to attract investment or do you want to supply investment? I would be in favor of saying, look, India can use additional capital to supplement our investment, domestic savings to grow faster, right? So we want to attract capital. Once you fix that, you will run a current account deficit. Now, when you say we will run a current account deficit, we'll be exporting some things and we'll be importing some things. Our imports will be higher than our exports. That's a mathematical reality. So we'll be exporting stuff that we're really good at. We'll be importing stuff that we may be good at, but we are less. In economic theory, it's called comparative advantage. We have a comparative advantage in services. So we will be a net exporter of services. And if we have to be overall net importer and a net exporter of services, we will be a net importer of goods. So there is no problem to solve on the export side. What is needed, therefore, for manufacturing to grow is domestic demand. Right? If we have more domestic demand for manufactured goods, manufacturing will do. And as I keep saying, that the domestic demand for manufactured goods all depends on housing. think about it, right? All durable goods demand requires you to have a house. If you have a small house with 5 people living in a room, there's only one fan, there's one AC at max, few lights. Even the amount of clothes and shoes they can buy is limited, right? You have no room to keep it. You have no wardrobe. If you have a larger house, you will buy more manufactured goods. Manufacturing will do well automatically. I can assure you that if we have demand for fans, somebody will make the fans. It's not as if there will be no fans made, right, in this country. So ultimately, it goes back to there is no problem on the exports front. Our service, we are a net services exporter, a net goods importer. That's perfectly fine. There is no problem to solve there. Domestic demand is needed. Domestic demand depends on housing. It's very interesting, right? You think about what we export in manufactured goods. We export pharmaceuticals. We export automobiles and auto components. If you think about it, these are the only things that don't depend on the size of the house. You consume the same amount of medicines, whether you have a small house or a big house, right? So we have good domestic demand, we also export them. You will buy whether you have a small house or a big house, people buy a two-wheeler, people buy a car, and they fight over parking space, but they buy it. Then we have enough domestic scale and the companies start exporting also. So for domestic manufacturing, absolutely critical that we have domestic demand. Otherwise, things are fine.
So housing is what should be the real focus. Should be
yes. Yeah. There is, in my view, there's no India story without a housing.
One formula that you have for the government and for the policymakers to think about. I'll take some questions from the audience. Ajay Bhoj, if you can please unmute yourself and go ahead with your question. Okay. We'll take the next one. Mr. Ajit Wakode.
Hello.
Yeah.
I'm Ajit Wakode. Sir, you have spoken about US tariff policies and explained how it will affect pharma, steel, housing, and textile. But what effect this policy will have on the key in the Indian industries such as agriculture?
See, I mean, like we I mean, in the sense, what do we mean by policies on agriculture? I mean, we produce enough food. The price levels in India for most cereals are well below price levels in international markets. So I mean, I don't see why that should matter. See, the reality is 1 billion people. I mean, there are very few. There will be some items that will get imported, right? I mean, but those are already. I mean, we do import some fruits, we import some vegetables, we import some, and we import edible oils.
Yeah.
To the extent that the incomes in India rise and land is limited, it's okay to import some food. Right? We should not be dependent on. We should have enough buffer stocks to handle volatility in supplies. Yeah. But I mean, the reality is that if income levels rise, we might. Land is limited. Agricultural output will not grow beyond a certain point. Right? Okay. Agricultural output is ultimately constrained by land.
Yeah.
Right? If we want to consume more beyond what we can produce, it's okay to import some. It's not the end of the world. India is a very Indian agriculture, right? Because of the land and this thing is not uncompetitive in general. The farmers work at very low wages, unfortunately. So that reflects the fact that price levels in India are quite low for most food items.
Okay, next question is from Mr. Jayesh Shah. If you can unmute and go ahead, please.
Hi, am I audible?
Yeah.
Okay. My question is that should we worry about bigger dumping in India just as because of Trump tariffs, because other countries may try to dump here since They may not be able to sell in the US. And I'm referring to Europe, China, Japan, and all the other countries where Trump is very aggressive in terms of imposing his tariffs, and he wants those exports to get hit.
So, look, it depends on what we mean by worry, right? Let me ask you this, right? And this is a very topical thing also, right? Firstly, let me also be clear, right? Actually, not everything that dumping in economics has a very specific connotation. A lot of what is referred to as dumping is not actually dumping. Dumping refers to when your domestic price is higher than your export price, right? If in China some prices are lower, right? Steel prices are lower, domestic market also, and their export price also, then strictly in economic terms, it's not dumping. Now, your question may still be valid that, look, price levels can fall so that to points where some Indian industries come under pressure. Now, the reality is, look, if we import more steel and steel prices are low, yes, steel companies take some pain, but does it really hurt the country? I mean, we can use that steel to buy more cars, to make more cars, and make more two-wheelers at more affordable prices. And this is my point that, it's very difficult. In fact, it's incorrect to talk about the impact on the economy as a whole. Tariffs hurt some people within the economy, help some people within the economy, right? So you tell me, if steel prices were to fall, yes, the profitability of steel companies would suffer, but would we not benefit in the downstream industries?
Right. But for the entire manufacturing sector, and again, I'm looking at the global math that if China is the biggest exporter to US and Trump really tries to reduce the Chinese export, which will find its way into all the other countries, including in India, it would generally lead to overall deflation globally and impact everybody in that sense.
Right. So to the extent so what we are saying is, look, if there are more imports, right, then if imports increase, our exchange rate will adjust to bring them back in balance. I am all for saying that, look, we should not allow our current account deficit to expand beyond the point, right? And that's where I started. That right now I don't see a problem because the current account deficit is fine. So if we do see a situation where imports are increasing because of the factors that you mentioned, rather than impose tariffs on individual items, right, because that is distorting specific things, then we should let the rupee depreciate to the point that the current account deficit remains contained. But that has not happened yet.
Got it. But in that case, again, rupee on.
Okay. So
I'll just make, I think he was talking about the rupee. See, the rupee is not our army. A strong rupee is not necessarily good for the economy. The objective is that we should maximize output in the economy. If that requires a weak rupee, that's fine. Today, that's not required, right? As I'm saying, the current account deficit is fine. So today, we don't need a weaker rupee. But if that situation were to arise where there is a lot of imports because of whatever reasons, the rupee can be allowed to depreciate to accommodate.
On your textile example that you gave, there was a follow-up question, so I'm taking it up from the chat. He's just making an argument. Why do you think textile sector will not be adversely impacted because of higher import tariffs in US? India competes with China and Bangladesh, and they are more competitive, and textile is a labor-intensive sector. So tariffs in US.
No. So I'm saying, look, okay. So the argument I was making was that if it's an issue of reciprocal tariffs, and if we reduce our import duties on textiles from the US is not making much textiles for us to import anyway. So there will not be any change. So we could very easily reduce textile duties on imports from the US. That was the argument.
Yeah.
There's hardly, the cost of production in the US is far higher that even with negligible duties, I doubt very much would come in. And frankly, if it comes in, then it's fine. The Indian consumer benefits from lower price for clothes.
Well, one question that maybe everybody wants an answer to is, when do you see market stabilizing, and do you see it further going down from the levels that we are? We are already down by around 15-16% from the highs that we had hit around 85,000-86,000 levels. The Sensex.
Look, it's I don't like to give short-term views in the market because the markets, like if you were to ask me what are valuation levels like, I would say in large caps, valuations are reasonable. Small cap and mid cap valuations are still high. And in small and mid cap, I would say it's not just valuation. It's some of the companies are very much weaker than the market thinks, right? So they will disappoint going forward. Now, if I say large cap valuations are reasonable, does it mean that they cannot become cheaper? No, right? I mean, in the short term, markets can become cheaper than what is fair value. So can that happen? Yes. But are valuation now reasonable in the large cap space? I would argue yes.
There's one question, Mr. Dhananjay Murarji. Can you go ahead with this Europe tariff reduction question in case you're there? Or I'll ask on his behalf. Will Europe follow USA on tariff reduction demands? China is turning around according to the foreign media. Achha, he's there.
Yeah, hi, I'm there. You see, I've been following on the foreign media that China is now beginning to turn around. They've cleaned up their economy. They've brought in Jack Ma and they're talking to their people to say that, why don't you have a look? They've realized their mistake. Even companies like Cathay Pacific, the Swire Group and all were partially acquired by the government, Chinese government, that sent out very negative signals. Now everybody has realized that the raw material producer of the world is China and they can't do without it. So that recovery and the stimulus from the government and various factors are coming in. So my first part of the question is that will Europe follow the American model to say that India should reduce tariffs on wine and cheese and European products and car parts, etc., etc.? Furthermore, on the subject, with the 1.8 billion euro demand on Volkswagen, what is going to be the fallout of that with the European Trade Commission? Further, they say that as we were talking about dumping also, as I'm talking about cars, you were saying that if the product is cheaper in the domestic market than it is in the export market, then it's considered dumping. But Tesla cars are not selling in America. People are not liking them anymore. Europe has gone off Tesla because Musk was interfering with the European elections. So they've lost 25% of their market share and they really need another market to put these cars here. So is this cyclical between America and Europe, and what is going to be the effect of that here? That's one part of my questionnaire. So if you could expound on that.
Keep it short, because it's going on and on, yeah. So if you can let him answer.
I was giving him a little reference point.
Yeah. See, firstly, we've always held the view that the Chinese economy will recover. One should not have built any assumptions that the Chinese economy will never recover. What we have to understand is why China slowed down. And China's slowdown was a consequence of its success. See, remember I'm talking about India doing well in housing, India building cities.
Yes.
So what has happened in China is that over the last 40 years, right, they've built a huge amount of housing, they built a huge amount of cities. The urban population in China has gone up from like around 200 million to 900 million. So they've moved like close to 700 million people from rural areas to cities over the last 40 years. Now, that is a huge success. Now, what happens when you do that, right, is now once you've moved 900 million people, the number of new houses you have to build is smaller. So supposing in one period you moved 100 million people from cities, from rural areas to cities. Yeah. And next period you move only 50 million. You're still moving, but number of houses you have to build now is negative, right? It's declining.
Yes.
Right? It's mathematical. So now all the people who were engaged in home building, who were engaged as brokers, making furniture for houses, there is by definition, because you've built all the stuff that you need to build, less demand for that, right? So
Yes.
that suffers from a period of weak demand. So what needs to happen, right, is all these people get fired, they lose their jobs, but they will find other jobs. They will become, like when we say China will move from an investment economy to a consumption economy, what we are actually saying in practice is these people, the Chinese, will take more holidays. Some of these people they will go out, enjoy life more. They will eat in restaurants more. They will have more fun, do gambling, whatever, do more. So to say that Chinese economy is in such serious trouble that it will never recover was anyway false.
No, I don't go on that premise. I go on the premise that the world was not wanting to favor China because of its military and foreign policies. So there was a kind of a shun towards China because of the Taiwan business that was going on. So people have now realized that they can't do that. And
let me again look at capital flows. The world may not like China, but the world needs their money. Right.
Yes.
So it's not as if, in fact, it is not that the US wants to say no to China. The Chinese have also realized that, look, why should we use all our reserve savings as a country to buy US government bonds, which yield so little? The Chinese are saying, look, rather than us buying US government bonds and the US government then going out or the American enterprises then going out and investing in other countries and earning a high return on them, we will invest directly. So the Chinese are doing stuff like saying, look, rather than us buying all our government bonds, let's go and do Belt and Road Initiative. So they are going out and buying ports, businesses, etc. in other countries. You always have to remember, the country that is supplying capital is not in a weak position, right? So this notion that all the power rests in the hands of countries that are recipients of capital is a flawed notion. China is the supplier of capital. You don't fight with your banker, do you? Right? So that the equation is not as if there is US and Europe and China is weak and cowering, waiting for what they decide. Right? China has its own strategy. China has a Belt and Road Initiative, which is essentially saying, look, rather than us buying US government bonds, let us go and buy assets directly in other countries.
Yeah, with that, we'll like to end this. Thank you so much, Anish, for taking all the questions and bringing so much clarity to us.
Monojit? Thank you, Sandeep. It was my pleasure. Thanks for having me.
Yeah, Monojit will have you.
Yeah, so I'm the same thing. Sandeep has said it. I mean, I'm sorry, Anish, and I'm sorry, everybody. I had to go away for some time in the middle. I mean, there's an edition tonight, so I had to go away. But you know what I heard? I mean, thank you so much. I mean, so incisive, so clear-headed. And, you know, people like us who don't understand economy and business as much as, I say, Sandeep and you do. I mean, for us, this clarity and this complete lack of jargon and there's no wishy-washy thing. I thank you so much. I will go back and listen to the YouTube version of this, which will be uploaded on the Indian Express YouTube channel shortly. And I urge everyone who's here to go back and share it and talk to others about it. And we will keep coming back to this. I'm sure many questions that have been answered here. And Sandeep, through his reporting, and the rest of us through all that we read and we edit and we kind of engage ourselves with. Thank you, Anish. My thanks also to our partner, Avito. Thank you all for coming. Good evening.
Thank you so much, Manjit. My pleasure.
Bye.